If I explain the step-by-step cash flow statement, this is also a method that can be used a lot in practice. For cash flow from operating activities, remember, in operating, investing, and financing, it's plus, minus, minus. You must remember this. In the main business, money comes in, you make investments, and then with the money you earn, you pay off borrowings and buy treasury shares, so cash goes out. So if you see plus, minus, minus recorded, you can just conclude that it's the cash flow statement of a solid company. I don't want to analyze any further. At minimum, check for a consistent plus, minus, minus pattern in the cash flow statement. If present, there are likely no issues and you can proceed. For additional insights from the cash flow statement, continue listening to the following content. Early stage companies, such as startups or newly listed firms, typically do not show positive operating activities initially. Since their net income is negative in the short term, it's really hard for this to be positive. But because they're investing for growth, of course, the investment section is negative. Early stage companies typically have a positive financing activities section since they rely on external funding to cover their expenses. The other sections are usually negative. It's not unusual for an early stage company to have negative and positive financial numbers. That's the proper perspective to view the company's situation.
That's fine. But
if this continues and eventually someone in financial activities refuses to lend you money, that's when the company goes bankrupt. So in the early stages, this isn't really risky. But if it seems like no one is willing to lend you money and the company doesn't have any borrowings, but things are getting harder, then the need for window dressing starts to grow. Because you have to make it look like it's a good company. Since investors are coming in, you start massaging the numbers, doing things like window dressing. So for early stage companies, it's okay for now. I'll talk about risky companies later, but as we move to the next stage, as I mentioned in the cash flow statement and the income statement, we've talked about the business life cycle and the different stages of growth. The cash flow statement also reflects these growth stages. For growth stocks, like the ones you manufacture, Chief Executive Officer, this is how they appear. So in operating activities, it first turns positive, it shifts and becomes a positive inflow, but the company is still investing a lot. The company is investing so much that the cash earned from operations alone isn't enough to cover the investing activities. Much more cash is needed, so they still bring in cash through investing activities.
so growth stocks.
So what you see is plus, minus, plus. It appears like this. If a growth stock looks like this, then there's no problem. If a non-growth stock appears like this, then there's a problem. But if a growth stock appears like this, you can understand that it's growing well, and there's no issue. Next, blue chip stocks. Blue chip stocks are companies that have entered the maturity stage. Like I mentioned earlier, companies like Microsoft or Amazon, these big companies, growing companies, or utility companies and consumer goods companies, most of them are already in the maturity stage. In those cases, they make a lot of money from their operations.
They earn a high income, but struggle with investing.
They invest minimally and use excess funds to repurchase their own shares and similar activities. Apple is a prime example. It generates huge profits but invests little, using most of the money to buy back its own shares. Apple belongs in this category. If you look at Microsoft now, it used to be in this category, but now it's moved over here, entering a mature phase and is currently investing for a second stage of growth. That's the interpretation. Few companies stay in the mature phase forever if they don't do this. Except for companies that make food, like Hershey, chocolate, cheese, or candy, which can stay mature for a long time without investing in facilities, most companies don't stay in the mature phase forever. So companies like Microsoft, Google, or Meta need to make investments to return to the stage of entering a new early phase, and if that succeeds, they can experience a second period of growth with a big leap forward. You can see how a company is operating in those areas through its cash flow statement. At the final maturity stage, these companies generate revenue from operations but cease investing. Money continues to flow in as investments mature or as they divest, changing their financial pattern. And then they become share buyback companies, but the ones we should target for investment are exactly these two, the ones highlighted in yellow, right here. On the cash flow statement, what we can invest in is this. And if we want to discover something a bit earlier, some people buy here as well. What I want to explain is how to buy early growth stocks, how to buy at the point when a company moves from the early stage to here by looking at the cash flow statement. The most important point is when the cash flow from operating activities turns positive for the first time. That's the earliest point you can buy, and it actually shows up that way on the cash flow statement. Be cautious of risky companies with negative operating cash flow, like early stage firms. They also have non-negative investing cash flow, indicating they're not investing due to lack of funds. But regardless of whether financing activities are positive or negative, if the negative operating cash flow continues, the company is very likely to eventually shut down. So, having negative operating cash flow can only be sustained when a company is in its early stages. That's how you should see it. In the early stages when the company is growing, that kind of growth, if your sales growth rate is high, 30 to 80%, you can continue operating despite negative cash flow due to ongoing investments. However, if sales are non-existent or growing slowly, e.g. 8%, and you're still in this situation, the business will likely fail. Investing in companies that will likely have to shut down is not advisable, as they will be forced to close their business. So to sum up, what you need to be careful about here is that there are companies that used to be in the growth stage or were blue chip stocks. There's a company with a cash flow statement that looks like the kind we want to invest in, but suddenly it starts to change like this.
There are some, suddenly.
The operating activities suddenly turn slightly negative.
It was positive. That.
Avoid considering that company. Sell it immediately. Because once it goes down like this, it never comes back up. That's right, it goes like this from here, but it never goes back up from here. Then because the company is likely to go in a direction where the chances of bankruptcy are very high. After entering the maturity stage, if the company doesn't grow or something happens, there are a few industries and companies that come to mind. They were once large corporations, but now they're consistently underperforming and losing money. Be cautious with those companies. Even if they give high dividends, if they can't make money from their business, they won't be able to pay dividends. If you wait until later, once they start turning negative, everything will just collapse. You shouldn't get involved at all. So I would recommend looking at cash flow companies that are in their growth or maturity stages. Next, I'll discuss 3 practical application methods and conclude. The first way to use the cash flow statement is that it's very useful for identifying growth stocks early on. I actually use this a lot myself, and this concept is also built into our investment recipe under discovered growth stocks. So if you feel like you can't identify them yourself, just click on Discovered Growth Stocks and you'll see options that already reflect this concept, so you can just refer to those. So even things like Astera Labs that I mentioned last time are all included there.
They were included there. Growth is.
They experience significant growth without net profit, but maintain a positive cash flow, a pattern typical of early growth stocks. This pre-screened information can be valuable for first-time investors. To view the steps, first examine the quarters. Simply observe them. To see an annual operating cash flow surplus, you must sum up all 4 quarters, which takes much longer. You need to look at the first turn by quarters, so check it by quarters. The operating activities were continuously in the negative, but suddenly turned positive. Then, for now, you should put it in the interest stage, but sales and growth rates should still be quite high. Companies not meeting the criteria become uninteresting stocks at this point. The sales growth rate is 50%, even 100%, but the cash flow is still negative, so when should I invest? When it comes to these kinds of companies, if their quarterly operating cash flow turns positive, you should definitely put them on your watch list. Secondly, the positive cash flow should persist for 2 to 3 quarters. In many cases, it's positive for 1 quarter before turning negative again. So if it stays positive for about 2 or 3 quarters, then you can consider that it has passed the next stage. So the next thing you need to check together is this. Check the sales or earnings per share consensus data for the next 2 to 3 years, and if the sales growth rate is high, or if the earnings per share is expected to turn profitable for about 3 years, then you can confirm with that data. From that point on, there is almost no risk, although there is still a chance it could fail, but at least in terms of cash flow, it's a company that has entered a stage with no problems, so you can consider buying shares in such an early stage company. So there is risk, but you can enter a phase where the expected return is much higher.
This doeo daishi.
In the case of this company, it has also grown a lot. This annual data for 2020 shows the cash flow from operating activities turned positive for the first time, reaching $250 million. The operating cash flow continued to increase and remained positive from then on. It was in December 2020 that it turned positive for the first time. In 2020, the net profit showed a loss of $460 million, while the cash flow was $250 million.
It's a surplus, so.
Investors may see a $460 million loss as a sign not to invest, which is about 600 billion won. Continuing such losses for 5 years could lead to bankruptcy. However, analyzing the cash flow may provide a different perspective on the company's financial health. And when you look at the consensus data for the future, you can see that growth is real. So if the cash flow gets much better than now, eventually the net profit will follow. You can interpret it that way. The reason there's such a big difference between this net profit and the other numbers is because of things like depreciation, which I mentioned earlier, and fair value assessments. If you can look up and analyze up to that point using EdGuys, and if you're going to make a decision to invest a significant amount of money, it's right to look into it that thoroughly before making your decision. So I think you'll be able to look at those things as well, as long as the data is prepared. So it would be good to use it for discovering initial invoice lines. Second, it's useful for identifying companies whose sales are expected to surge after making large-scale facility investments. Earlier, Microsoft would also fall into this category. Since Microsoft has almost doubled its investment, we need to take a closer look at the process of doubling their investment. NVIDIA and other companies making large-scale facility investments fall into this category. The first stage is that the cash flow from investing activities must suddenly show a significant negative figure.
That's right, always.
Doing it similarly means making investments at a similar level every year. If we say, as we mentioned earlier, that these are sleeping growth stocks, then for those companies, the cash flow from investing activities needs to suddenly show numbers that are different from before for us to say that they're sleeping. If it's always the same amount every year, there probably won't be significant growth. To jump high, we need to crouch down first. If you don't crouch and stay upright, you can't jump far. So the first thing you need to check is to pay attention to the year when the cash flow from investing activities suddenly shows a large negative figure. Next, check where the money was invested. There are two main categories for where that money could have been invested. One is investing in tangible or intangible assets, and the other is investing in stocks, securities, or similar things. So if it's not invested in stocks or bonds, then you can judge that the company increased its tangible assets, like facilities, or acquired intangible assets through M&A for the future. So you can see that the company is aiming for further growth next time. Next, what's important is that the sales growth rate should at least increase as much as the growth rate of tangible assets. For example, if tangible assets increased by 50% but sales only increased by 5%, the company heavily invested in facilities, but products aren't selling well. So it's really important for us to check whether the sales growth rate is reflected in future consensus data along with the growth rate of tangible assets. So since the sales growth rate is already shown in the consensus data, you just need to check if it's increasing as much as the tangible asset growth rate. If they're growing at a similar rate, you can interpret it as the products are selling well. So as an example here, NVIDIA had a large cash outflow in 2021, about $19.6 billion. If you look here, you can see there was a significant dip into the negatives at that point. Investment activities decreased slightly after that, but have recently begun increasing again for a second time. So through this chart, you can see that NVIDIA has had two large-scale investment activities, and if you look on the right, you can also see it in the numbers. So if you look at the cash, in 2021, it's minus $19.6 billion.
It went out, and then...
As of July 26, 2025, you can see that they invested $20 billion again. So compared to the past, you can see that the amount has increased significantly. So if you want to check where this money was spent, you look at the financial statements. I mentioned this in the first session. Where the money was spent is recorded as assets. I told you this back in the first week for these sessions. In 2021, tangible assets saw a modest increase from $2.2 billion to $2.8 billion. However, short-term investments rose significantly by nearly $10 billion. Intangible assets also grew by approximately $6 billion during the same period. So most of the money that was invested went into short-term investment assets. What are short-term investment assets? On the financial statements, short-term just means anything less than 1 year. So you can think of it as money that can be recovered within a year, being tied up somewhere, whether it's in bonds or MMFs or something else. Next, the intangible assets here are investments made in M&A. I looked into this a bit, and in April 2020, they acquired an Israeli company called Mellanox, which is a listed company, for $6.9 billion. MBDA only makes GPUs, but Mellanox was a company that was quite advanced in artificial intelligence, related networking, and similar fields. This money was used when they acquired that company. This company used this much investment, How did they raise the money for this? They earned $5.8 billion from business operations, borrowed $3.8 billion from financial activities, and that alone amounts to almost $9 or $10 billion.
And then...
The cash they already had on hand, you can see how much their cash has decreased. In total, they raised and spent $19 billion on investments. $10 billion was allocated to short-term investments, while the remaining funds were invested in intangible assets. So the company did M&A for growth. At this point, you have to look at it as this moment in time, but I think what's even more important than this point is the recent moment. If you look at January 2025, the tangible assets are $8 billion, and the speed at which it's increasing is quite steep. So they're investing $3.6 billion, $4.8 billion, $5.2 billion, and $8 billion like this.
They're investing like this.
Because they're investing a lot. NVIDIA. Chief Executive Officer Jensen Huang is investing in tangible assets, likely because he sees the potential for increased sales from this investment. Just because these things increase tangible assets doesn't mean they're immediately reflected in the income statement, because the way tangible assets change, I'll explain while looking at the next page. How do tangible assets change? When I talked about inventory assets, I said that raw materials, once they're being processed, become work in progress and are in the middle of production. Raw materials become work in progress, then finished products ready for sale. When sold, they generate sales revenue. These three stages, raw materials, work in progress, and finished products, are the forms of inventory assets. What forms do tangible assets take? Consider tangible assets carefully. To make a facility investment, land is required first. Let's assume you have the land. If you want to build a factory, you need to prepare the land, buy raw materials, and build it step by step. You can't build it in just 3 days based on the tangible asset investment. If it takes 6 to 8 months to invest in facilities, then you spend that time building the factory. Then cash keeps going out, right? Since cash is being spent, all of it will be recorded as tangible assets. But does that company produce any products? No, it doesn't. What do you call the state of a factory that is still under construction? Once the facility is completed, it becomes a tangible asset. We call it construction in progress. Construction in progress means the construction is still ongoing, similar to work in process that we discussed earlier, indicating it's still in the process. In Korean financial statements, this is listed under the account title Assets Under Construction. In English, it's called Construction in Progress. And in Korean, it's Assets Under Construction. What this means is that it's not finished yet. Since it's not finished, it can't be used to produce products yet. Investing in tangible assets does not necessarily increase sales. In fact, the ratio of those assets being converted into sales tends to decrease temporarily because there's a time lag, right? You have to wait for that lag until it can produce products, and then you need to watch how quickly it recovers. So if you look here, compared to a year ago, a lot has already increased. The assets under construction, once another cycle passes, this amount will decrease. This amount will keep decreasing, and when it's completed, where will it go?
Where will it go? Things like that.
The value of the factory or machinery will increase, right? If you look, the amount of machinery has increased significantly. The factory and machinery are completed because this is where they quickly produce things. From now on, NVIDIA's assets under construction will decrease rapidly, and as they decrease quickly, the number of factories, machinery, and equipment that are actually recorded will increase. This increase is necessary to produce products, and only when products are produced can it lead to sales. So, because there is a time lag, people say we can't see the future from the financial statements, but that's not true. Because we're planting the seeds for future sales here. We're looking at those seeds. Financial statements provide meaningful insight into a company's future direction. Questioning their significance suggests a lack of understanding of their value beyond historical data. So the seeds of future growth are planted in both the balance sheet and the cash flow statement. Only the income statement uniquely shows the current performance, while the balance sheet and cash flow statement contain the seeds of the past, present, and future.
They are financial statements that contain all of those.
Please try to look at it this way, and even if it's a bit difficult, try to care about the financial statements as much as you care about earnings per share.
If you subscribe,
I think you'll gain a much broader perspective and you'll be able to invest with a bit more confidence. This is the last page. Lastly, it's useful for filtering out insolvent companies or those suspected of accounting fraud. Supermicrocomputer's stock price has recently risen significantly, indicating signs of recovery. This company is a representative case. This is a growth stock, and it's a case where net profit is increasing tremendously. Usually when a company is growing, as I mentioned earlier, the net profit is negative. The basic cash flow of a growth stock is that the cash flow from operating activities is positive like this. But in this case, the opposite happened. The net profit turned positive first, but the cash flow from operating activities hasn't turned positive yet. So it could happen for a quarter or even a year, because it can happen if there's a large-scale facility investment. But in the end, if net profit is positive for a long time but cash flow from operating activities is negative, that's really tough. I mentioned this earlier. Cash flow from operating activities starts from net profit. The net profit is extremely large right now. But after making these adjustments, if this turns negative, that's a very rare case. So generally, when net profit is negative and operating cash flow is positive, that's how early growth stocks usually appear. In the case of Supermicrocomputer, it was generally correct for it to appear that way in the early stages.
That's what it is, but
Well, we can wait a little bit, since there could be some unusual cases. But if this keeps getting longer, then it's a situation where you need to be a bit more suspicious or manage the risks. To check, first see if net profit is positive, but cash flow from operating activities is significantly negative. That's the most important checkpoint. Second, look at why the cash flow from operating activities is negative. If you don't really understand the composition in that case, then it's right to turn on a red flag. The third step is to take a good look at how the company raised cash through financing activities. From the company's perspective, they choose between borrowing and issuing new shares. There are two different ways, whether to get funds from shareholders through a paid-in capital increase or through borrowings. Borrowings require paying interest, while issuing new shares does not. After making a profit, the company can either raise the stock price, returning value to shareholders, or pay dividends. For companies, issuing new shares is often the best option because it doesn't require interest payments. If a company lacks cash flow and is considering financial activities like a capital increase, issuing new shares is more beneficial than taking on debt. However, when companies attempt to issue new shares, people don't always follow suit. Investors, such as institutional investors, do not participate in things like this.
they don't. So
Ultimately, they continue borrowing or engage in such activities. When borrowing is no longer an option, they must appeal to individual investors to sustain capital growth, necessitating the manipulation of financial products and similar practices. So, if you look at these parts, you can see that financial activities go up like this as a positive number. There's data from June 2024 before that issue happened, and it's on an annual basis. Analyzing the company's annual financial data reveals sudden spikes in financial activities. Despite substantial profits, the company struggles to generate cash from operations. To compensate for the lack of funds, they heavily rely on financial activities without significant investments. If so, it's reasonable to find it a bit odd. Actually, if you look at our chart, this is the company's smart score right now. If you look at these 5 categories, future growth is extremely high, and in terms of financial stability, except for cash flow, they scored a perfect 100. Profitability is good because they're making money. So their margins are decent and they scored fairly well. But the only area where they didn't score well is this one. They barely got any points here. These are the things that our artificial intelligence algorithm checks in the data. So everything I mentioned earlier, that needs to be checked. The artificial intelligence takes care of it. So if you look at the cash flow statement and see that it doesn't look good, you'll see it show up like this. If you're a beginner and you really want to check the cash flow, check this area. If it's below 10 points or even 0, then it's best not to look at it. It's really better not to look at it. So, even though this isn't something you'd normally cover in elementary school, I thought you might get confused, so I'll mention it briefly. I'm not sure if we'll cover this in middle school later, but anyway, if we do, I want to start by saying that financial companies are a bit different. Watch carefully. The current cash flow statement is designed for manufacturing or service industries, with operating cash flow representing the main business and investing and financing involving borrowed funds. For financial companies like banks or investment firms, what would be considered their main business? Their main activity is raising funds and lending them out. So, would this activity be considered a financing activity or an operating activity?
then
According to general accounting standards, it's considered a financing activity. Then for financial companies, how is it recorded? They receive deposits and savings from these investors, right? As their assets grow, they make more money by lending, resulting in a huge positive cash flow from financing activities. Contrary to what we initially learned, a positive cash flow from financing activities could be viewed differently in this case, rather than as a sign of failure. So for financial stocks, even if they don't score well there, it's a bit different. We have a separate algorithm to check the cash flow of financial stocks, so we're making adjustments and not judging them the same way. When it comes to financial stocks, what's the essence of finance? Their main business is borrowing and lending money. For financial companies, cash flow from financing activities is their core business, which is evident in their cash flow statement. So if there's a positive inflow there, that makes sense. It's normal for manufacturing or service companies to have a positive cash flow from operating activities, and for investment or financial companies to have a positive cash flow from financing activities, as that's their main business. If you understand it that way, even though the financial industry, card industry, and cash-based industries can be complicated, you'll be able to gradually broaden your understanding based on this foundation. For those studying financial stocks, it may be confusing when a chief executive officer says positive financing means bankruptcy, yet all financial stocks, including Visa and investment, are positive. Does this mean they're all going bankrupt? The same applies to Moody's, as the primary business of the financial industry is financial activities, so you should look at that a bit differently. So, if you make a good judgment based on this, even though these companies might be a bit difficult, it's better to filter out companies like these using the cash flow statement, especially those that have been around for a long time. That's how I can summarize it for you. Actually, in today's class, I just pushed ahead without giving Mr. Chief Executive Officer any chance to summarize or even take a breath. It was a bit long though. If you review these things about cash flow well, you can consider yourself at a higher elementary school level when it comes to understanding this. But those who look at it that way and invest, and those who don't, will probably have very different perspectives. So please don't give up, and I hope you stay strong and keep cheering until the end.
I saw a comment last time, and that's what they said, United States stocks. There was also a subscriber who said they hope this continues from elementary school to middle school and high school.
I can't say for sure about that.
I'm not sure about that, but I hope it continues well. If I get the chance to go back to Korea later, I should take the executive management course too in person. Actually, today wasn't that long in terms of time. Since we covered a lot of ground and I'm also here to learn, I thought it might help the viewers if I summarize what I've understood so far. Let me add a few words. At the end, among the three options, we used Suho microcomputer as an example of a stock we might want to avoid. At that time, the first sign was that although the net profit was showing a large surplus, the operating cash flow was negative. If I explain using this example, what kind of people are there? In fact, if you look at the returns for this year, Super Microcomputer has surged more than 50%. So since they missed out on such a big rise, some people might think negatively, saying that learning this kind of thing doesn't really apply in practice. I just wanted to say a word about that. I always tell my subscribers that when evaluating stocks, never do an absolute evaluation, but rather a relative evaluation. So there are over 6,000 companies listed on the United States stock market right now. But out of those, we usually pick at most 20, and some people pick 10 or even just 5 to invest in. But I want to say, do we really need to invest in companies that have risk factors, something that feels off, declining growth rates, are under censorship, or are suspected of accounting fraud? Well, SMCI has gone up about 40% over the past 6 months, but that's just looking at the results. Ultimately, the outcome may differ, and currently, the one-year return remains negative due to the significant drop that occurred previously. So, what I want to say is, the reason we're learning these theories is because, in the end, investing is about getting rid of stocks that are likely to fall and finding stocks that are more likely to go up. Within these theories, I think it's good to think about how we can filter out stocks with risks. Despite these issues, some stocks will still rise. It's an unavoidable reality, and that's the point I want to make. And now, today's highlights can actually be summarized into about 2 main points. When we invest, we're not investors who put money into ETFs, but rather we select individual companies to invest in. How can we find growth stocks with a high probability of rising in the future? Or should we look for sleeping growth stocks that are taking a break right now? I think it would be good to focus on these two things. For growth stocks, as I mentioned earlier, the first step is to find companies that suddenly turn from a loss to an operating profit in a quarter. And not just for one quarter, but if they maintain that operating profit for 2 or 3 consecutive quarters, if that turnaround to profit continues, we need to keep an eye on that. Another thing is if the guidance for sales or performance shows a very solid growth rate for about 2 or 3 years, and if the consensus is also positive, then it's possible to conclude that we should pay attention to these kinds of stocks. Another thing, as we saw earlier with the example of Nvidia, we learned a very good lesson. The acquisition of a company called Mellanox didn't just mean that the company expanded. Recently, you may have heard a lot about this, but Nvidia doesn't just sell GPUs. They sell systems. These systems include GPUs, CPUs, and everything is connected with networking cables, so they actually sell the entire server. But the reason this became possible was actually because of Mellanox. So after acquiring a company like this, the competitiveness doesn't just become Nvidia plus Mellanox, it can actually increase in value by 2 or 3 times more than just the sum of the two because of the synergy effect. How do you find stocks like this? When a company's investment cash flow suddenly turns sharply negative and a huge amount of cash is flowing out, that's when we should pay attention. But we need to see where that money went. It's not just being spent on buying stocks or bonds. For example, if intangible assets suddenly increase due to a merger or acquisition like with Mellanox, or if tangible assets increase, let's say it's Meta, then it means they've bought a huge amount of GPUs. In this way, we need to look at where the money was spent. While we pay attention to this, it doesn't immediately translate into growth rates, but after 1, 2, or 3 years, we can see whether such investments actually help improve growth rates. So the main point today was to look at this step by step. But what I want to say here is that it's a bit difficult for us to do this one by one. So I'd like to give some homework to those of you watching this broadcast today.
1.
It's about finding one item each.
So in the comments,
I think we've just discovered number one in terms of growth rate. It turned from a deficit to a surplus, and it's been in the black for about 2 or 3 quarters. If you've seen stocks like this, I'd appreciate it if you could post them in the comments. On the other hand, I also noticed that, like Nvidia earlier, there are some stocks where the investment cash flow suddenly turned sharply negative. And if you could just check for each stock whether it's due to an increase in tangible assets or intangible assets and post it like this, we could simultaneously discover some amazing stocks together. So
This kind of assignment,
I'd like to give you this assignment. Yes.
if I could give a hint to those who can't even get started at all, I'd say refer to emerging growth stocks. There you'll find early stage growth stocks, but you have to look at them in cash. You need to check one by one to see if they fit, but that's a hint you can use. And for the second part, I think you'll need to look for those a bit, but if you practice looking at financial statements, as the Chief Executive Officer mentioned, it'll probably help you internalize and learn much more effectively. I'll look forward to seeing a lot of comments.
Yes, I really hope many people will give it a try in discovering growth stocks. Thank you for another really useful lecture today. Is this the end of the cash flow statement series?
Yes, it's finished. Actually, it's not just the cash flow statement that's finished. The big section that started from the first class, which was about business activities and financial statements, has now covered the balance sheet, income statement, and cash flow statement. So this whole section is now complete.
So now it's like we've finished first, second, and third year, and we're moving up to about the fourth year. Yes.
Since we finished one section, we're now about at the fourth year level.
I think we should get ready for that. Yes.
Sounds good. By any chance?
Would you like a brief hint about what the next class will be about?
I haven't decided yet for the next session, but I'm planning to move on to investment indicators. So I'm going to cover a few important investment indicators in depth. First, I think we'll cover PER. In fact, there's an entire book just about PER. There's a separate book just about PER.
There's a whole book just about PER in our country.
A book has been published as an excellent translation. So if you look at that, it explains how to interpret PER, and depending on this, PER can become very meaningful. Sometimes you might think, isn't this outdated? Isn't PER unnecessary? Isn't price earnings to growth always the best? But actually, you need to understand PER well for price earnings to growth to be meaningful too. Since it's an indicator that can be expanded, if you really put your mind to it, you could probably talk about PER for quite a long time. Still, instead of just ending with theory, I'll try to prepare practical applications as much as possible so that I can meet you again in your 4th year.
Thank you. At first, when we started this segment, we were really worried about whether it would become popular. Looking back, more and more people have been leaving positive comments, and there are also many viewers who watch this segment repeatedly. They encourage us by saying that they've received a lot of help from this. So now that I think a chapter has come to an end, I feel a bit proud. You've really worked hard all this time.
Thank you for your hard work, Chief Executive Officer.
You've worked hard.
You always make difficult things a bit more fun.
It was challenging to stay awake, laughter. From next time, I think it will be more interesting than financial indicators, investment indicators.
We will be a little...
I'm quite looking forward to seeing what kind of content is hidden in the investment indicators we've heard about more often. Thank you for your hard work today. I'll see you again next week in good health.
Thank you for your hard work, Chief Executive Officer. Thank you.
Thank you.
The start of a dream is important, whether you're sleeping or awake. Be ambitious and grow little by little every day. Enjoy today's journey. Even if a dark focus comes, I'm not afraid. Retiring with United States stocks.